Hey, everybody. I'd like to introduce Matthew Rabinowitz. He is the president of Prime DST. They have been coming out. It's great. I just get on here and I get a frog in my throat. But Matt is the head of Prime DST. They have a current DST offering with us for 2 Tesla collision centers, and we are anticipating one going live within the next couple of days. Matthew's a great guy. I'm glad he was able to make some time this morning for us. Matthew, take it away.
Thank you, Mark. Thank you, everybody, for joining. Let me just give you a quick update or quick background on me. Thank you. My name's Matt Rabinowitz, and I run Prime DST with a couple other folks. And I also work with a developer that actually brings and has constructed some of this inventory. So background behind all of this is I would like my hope is that this can be much more of a dialogue, not just a monologue for me. So please, if there's a piece anybody has a question about, feel free to just jump in and interrupt me. That there aren't 400 people on the call, so we can do that. So just like 1 minute on the background on DSTs for those that are familiar or aren't familiar. In this context, a DST can be used, a Delaware Statutory Trust can be used to hold real estate of any type. And it can be used when structured correctly. It can be put together with the proper tax opinions that allow it to qualify for a 1031 replacement property. And that's what we've done here. So in that context, as folks rotate out of an existing property and have their funds with a qualified intermediary, they can then reallocate that into a DST. And from an IRS perspective, it is deemed as replacement property. Of course, folks can just participate that way also with cash. It doesn't have to be from property. But it's a passive structure that allows for passive gains and losses to flow through to investors. And those losses are from the capacity of depreciation, which we're going to get to here in a moment. But the background behind this is Tesla is the name that sells. And many people ask, why Tesla? And clearly it's an interesting brand, but there's a whole lot more to it from my lens that I'd like to share. And in that context, Tesla and their revenue stream, and the reason why we've really kind of targeted on the automotive sector as a whole is we view it as something that is resistant to challenging environments. We all saw what happened 4 years ago with COVID. And, being an owner of real estate that was in the movie theater space probably was really rough. But the collision sector space was very resistant to COVID. It was very durable. People still got in car accidents. In that context, it's COVID resistant. In that context, it's also recession resistant and Amazon resistant. Many of these net lease properties folks look at, it's always a question of what business model Amazon will go to, and will there be a sustainable business model in the decade? And collision center is very much resistant to that. Now, Tesla as a whole, as most folks know, I don't have to pitch on why electric cars are growing. That's already been done. But Tesla has basically cracked the nut on how to mass produce electric cars. And that's great. They've cracked the nut on how to get charging stations everywhere. The next challenge is folks still get in car accidents, and it doesn't matter if their autopilot tool of a Tesla works, it won't work perfectly while other cars don't have it. Collisions still will occur, and folks that get in collisions need to get their car repaired. And Bob's car repair shop down the street can't handle dealing with a Tesla. And what we've seen is that their growth of how fast Tesla can produce cars has massively outpaced their ability to both service them and repair them during a collision environment. And that's why there's a strategic benefit here, or an access point, if I'll view it that way. It's a strategic part of how they're going to handle this business model. And more specifically, it's neat that Tesla or any tenant says, we need more collision centers, just go. Challenge is building collision centers is actually not so easy. They require certain types of entitlements/permits that take time because most people don't want to have it in their backyard. So having it in a certain area, AKA by the airport, for example, there just aren't that many locations available. But one of the things that does, as long as assets are in strategic areas like major cities, they make it very useful if there's ever a problem with the tenant that the underlying asset could be, re-leased to another party. Although in this context, Tesla clearly doesn't want that. They want the building they've already got because they need it. So in that context, we work with several developers in this context. In this specific one, we've worked with one to secure the properties that Mark mentioned before. This first area we've got. What I find fascinating about this is that the single tenant net lease space is not really new, but this is basically, from a Tesla perspective, it's the very first net lease structure that's been put out that has a revenue stream that's guaranteed by Tesla, and it has a building. So by owning a DST, you have possession, which is even better than having a lien. It is the ownership of the building. Now, if you just put on your bond hat for a moment and you look at what trades in the bond market, the bonds that trade in the market are senior unsecured notes, and those trade around 4% for Tesla. And this structure that we're talking about putting together, it's the senior secured position, so it actually should even trade better. Now, let's step back. So not only is this a tax play in the context of a 1031 gain, 1031 replacement properties that allow for gains to be deferred as well as depreciation recapture, because these buildings are for Tesla, there are many significant customizations that Tesla required, whatever it would be, chargers or paint booths or whatnot. And as a result, the cost segregation analysis that was done on these properties on our offering that's outstanding, as well as ones that will be done in the future, we're seeing around 25% of the building qualifying for some form of accelerated depreciation. And investors that participate in these DSTs, that's a real meaningful percentage that flows through to the underlying investor, creating, without being too much of a tax dork here, that creates effectively like a tax shield, lowering the income for an individual investor, assuming that they can be written off against other passive incomes. It ends up finding a way to effectively bump up the yield. So while the number that the offering may say is X, when you include all of the tax benefits, it actually significantly enhances the underlying return of the property. Now, the other part that becomes interesting from my lens is that these are investment grade. Tesla is an investment graded company, and investment grade properties, and this is Matthews as a real estate firm put together a report outlining what investment grade net lease properties, quote, traded for in the market. In 2023, end of 2023, they were averaging around 4.82 was the investment grade, with the highest one being around 5.2. In this context, the properties in our first offering, they were acquired around, I think it was a 5.87 area. And the market on Teslas has already compressed down to a 5.5. And this is still in a high interest rate environment. We expect that we're targeting that as all of it at the end of the day trades over a treasury yield. And as the Fed has already outlined their target to decrease rates over time in the next year or 2 years, whenever it happens, then those treasuries will come down and thus cap rates will further compress. And because these effectively are trading like a bond, the end result will be we are targeting and hopeful for a significant appreciation for our investors whenever the properties are invested in, insert the year, 4, 5, 8 years, whatever the number is. That is what's for the best interest of all of the investors. And when those properties are exited, as long as parties want to move back into some other 1031 exchange, they defer all of those gains, they defer all the depreciation that we're able to take because of that cost segregation analysis, and it turns into a gigantic win. So the core of it is it's a strategic play on Tesla. By many accounts, if it's their family jewels, if you will, of where assets are strategically based. It's a real estate play, it's a tax play, and it's a yield play. And it's Tesla. And that's the whole with that, I'll basically, I'm opening up for questions. If anybody's got questions more about the underlying structure, DSTs, the tenant, any aspect of what we have in hand and what we are targeting, I'm happy to answer any questions.
I have a question. Can you hear me?
Yes, sir.
Yeah, my name is Roger Douglas. So you're talking about building buildings, and the way the article that I read about this, I understand that these buildings are going to be about 40,000 square feet. They're going to be connected to dealerships. Am I accurate with that?
They're I'm speaking about Tesla's collision centers in general are around 40,000 square feet each location. That's correct.
Yeah.
And it's not so much a dealership, it's a collision repair. So the objective is to take a car that got damaged, repaint it, refit it, whatever, redo a panel or whatnot, and then have it be in there for X number of days, and then it gets released back to the owner of the car.
Okay, so it will not be connected to the dealership. It'll be in an industrial area. Is that?
Yes, it's an industrial area, and some appraising parties call it retail because there is a retail aspect apparently to it, because it does have a supercharger on it, locations on it, but it, for the most part, is permitted in the industrial area of town.
Okay, so what you said earlier about 25% of our investment will be open to depreciation deduction?
Those are the estimates that I was told. Yes, and I'm getting the reports, the final version tomorrow on the properties on our first offering.
Okay, so I guess my question on that, if we're buying a building, why are we only getting 25% depreciation as opposed to 100%? Are we not limited?
No. This part's really important. So all of investors in a DST, one of the requirements from the IRS, it's not me makes this up, it's called the quote 7 deadly sins quote, where we have to treat all of the investors effectively as common. There's no multi-structure. There's no one party that gets some and some parties that don't get other. All of the depreciation flows through the building. Buildings depreciate at whatever it is, 39 and a half years on a depreciation schedule. And that's 4 walls and a roof. Okay.
Right.
That you still get that depreciation. It's the part of the buildings that qualify for the accelerated depreciation that I'm referencing that are about 25% of the underlying asset qualifies for that. So, and I think actually from January 1, the law changed to 80% of that number can be taken in the first year of an investment, which, depending on if you have gains to offset it, that basically should destroy year number 1 income completely, and in fact have a passive loss for year number 1.
Okay. What do you anticipate each one of these buildings costing?
Well, the answer is it depends on how much it costs to build it, and all of those locations are different. So the average, I would say, and that's, it depends on if you include the dirt cost and the acquisition cost. The dirt depends on the location. Clearly, some markets are more expensive than others. So some of them are, $1.5 million for the dirt. Some are $3 million for the dirt. The underlying buildings themselves, that's about, if you include all of it, it's about $11 to $12 million per building. If you include the location, the dirt, the building, the entire structure. That's just an average. It depends on the location.
Okay, so we have a 40,000 square foot building industrial area for $11 to $12 million, and each investor that's invested in that, does each investor own a portion of that building? How does ownership take place?
That's a very good question. So now let's forget Tesla for right now, because you're asking more of a macro question of the way DSTs function is by beneficial interest. From another way to call it in an LLC would be a membership interest or shares in a corporation, right? So it's a fractional ownership of the building. Just imagine you have one DST and one building, just for simplicity's sake. And keep the numbers very simple, that the total offering size is $100 million, just for simplicity's sake. And an investor puts in $1 million. That investor owns 1% of the building. And that 1% of the revenue, 1% of the profit, et cetera. It's 1% at that point.
Mm-hmm.
And then many folks have asked, I've got a friend of mine that works at an investment advisory business, and his client asked him, I'd love to buy one of these Teslas. And he said, that's great. It's only about whatever it was, 12 or $13 million. He said, well, I don't have that total amount, but I do have 800K that I want to put in. And the only way to get into a property like this for an amount shy of owning the whole thing is with fractional ownership. And that's precisely what a DST provides to investors.
Okay. And so the fractional ownership, okay, so we have a tenant. Do we have a building manager of that tenant also?
Yes. All DST investors have to be passive. So the whole is what another aspect that's interesting about DSTs is that the entire structure has to be passive. So everything has to be pre-decided before we even close. And then once the real estate closed, then you've effectively weld the box shut and you can't reopen the box. So the property manager is already known, it's defined. The underlying property has a tenant. In this context, it has a long-term tenant of Tesla, which is great. And it's a net lease. So Tesla is responsible for, way above 99% of all the brain damage that goes with maintaining the property, which is even better for the property manager, which is even better for the investor because Tesla covers most of those costs.
What do you say in that case? Are we talking triple net? Is the tenant then responsible for the taxes and maintenance, or is that the owner, the DST ownership that would be responsible for that?
Excellent question also. And it goes down to the lease. So for Tesla leases specifically, it's not a triple net, it's a double net and a half. And they carve out the roof structure. In this context, I think the roof has a 15-year warranty. So the taxes, however, are paid by the tenant. The insurance, and that is a really big thing, especially in Florida, the insurance is paid for by the tenant. That's not borne by the investor. But pretty much the rest of all the electricity, all the other things that typically are, quote, brain damage are covered by Tesla. In this context, just the tenant.
Okay. So that puts the responsibility of the roof on the ownership, the DST ownership. Is that the way I understand the summary?
It is on the DST investors, and the roof has a warranty.
Okay. What sort of return on investment are we looking at?
Well, there is the one offering that we have outstanding.
Put $1 million in. What are we looking at as far as an annual return on that investment?
So on our first offering that is outstanding, that offering return is 4.95%. And that is the cash on cash number. And that is before any of the depreciation that flows through down to an investor, which effectively bumps it up. I mean, everybody's tax rate is different, so I don't want to comment on yours because that's not appropriate. But if I make the assumption that folks on this call are in the upper tax bracket, let's say it's the 40% tax bracket, it's very different. Like if you're in New Jersey or if you're in California, then these numbers are probably even better. But that's everybody's circumstance is unique on that. But that passive income losses of the depreciation, it's a tax play. So it flows through. I think the numbers turn out to be it's 495 on the face of the offering, and then depending on each person, it can get into the mid sevens based upon the tax profile of every investor.
Right. Okay. Well, the actual cash to cash is 4.9% of the amount of money that you invest. Is that right? Accurate?
495 on our first offering. That's right.
Yeah. And then inside of that 495, we are responsible for roof maintenance.
It's not even maintenance on the roof. It's if the roof fails.
Right.
Tesla is responsible for the maintenance of it and to maintain the building. It's if there's a structural failure of the roof.
Okay. All right. Well, thank you very much for your answer. Thank you.
Sure, no problem. Happy to answer questions from anybody. Floor is open.
I got a couple for you. How do you determine how does Tesla determine where they want to locate these?
It's excellent. So Tesla, whenever you buy a Tesla vehicle and you drive it, it gives you that, you have to agree to the terms and conditions. Tesla uniquely knows where every one of their vehicles is located, all of them, which on a like almost like a heat map, if you can imagine looking at the entire United States, they know where the concentration of all their cars are. And as a result, they know where people get in accidents and where where the probabilities will be, which gives them a huge leg up on knowing where it's a critical component of their need. Just as an example, the San Antonio property that we were referencing before in our first offering, whenever it opened up, the day that it opened up, there was a wait list of 6 weeks to get in because they had demand out the years to be able to use the facility. So they have strategic areas they know are more important than others. There's no demand at present to go to Alaska, to my knowledge. But if there is in the future, they're going to know it well before their competitors will.
I was just saying they're using a void analysis to see where they need to put these collision centers to where they're most useful, it seems like.
Correct. Yeah, and it's both important for their business model, and as long as it's durable in the context of replacing it in the future, I think this is me speaking out of turn, but I mean, from my lens, I think the perfect buyer of buying these underlying assets in 5-10 years will be Tesla themselves, because they know how critical it is, that they basically can't afford not to re-up the lease because it's a strategic asset for them at that point. It's not easy to replace these things.
Okay. A follow-up question to Rogers. When you're saying 25%, you're saying that that's 25% depreciation in year one, correct?
No, it's the the portion of the building that qualifies for accelerated depreciation. So, and again, it's also the blended number. So some assets in a building qualify for different time horizons. So like whether or not something takes a 15-year life cycle or 6-year life cycle, or maybe it's the sign on the outside of the building that says Tesla, that's probably on a 1-year life cycle. We took from our lens, we took a conservative view and made everything 15 years. That's how I'm modeling some of the numbers I'm referencing. But the 25% is of the entire purchase value of the building. So just again, like if we took the building saying it costs $10 million to build the entire building and $1 million for the dirt, then out of that $10 million building, approximately 2.5 million of it would qualify for some form of accelerated depreciation. And again, that's what the cost segregation analysis will show us will be, and I'm making up this number, so don't quote me, 1.375 million will qualify for 15-year depreciation cycle, but 600K will qualify for 1-year depreciation cycle because they have sent engineers and their CPA people to go both dig through the entire GC building, the as-built reports, the whole design of the building to provide an analysis of that breakdown so that it's all on different schedules. But that report done by a CPA firm will tell us the exact percentage and how it's broken down.
Okay, thank you. I don't see any other questions, so I'll throw a few more. Where are you guys looking to build these at this point? I assume you have a few in the queue besides Net Lease 1.
We have another one that is coming out, air quote soon. It's in major markets. We're connected as an affiliate at the hip with a developer that builds this stuff for Tesla. Tesla has several developers, but they have 4 preferred developers, and the affiliate that we work with is one of those 4. And that affiliate developer is presently building, projects in Indianapolis, in Kansas City, in Reno, Nevada, in Charlotte, and or has exited some of those in those markets. So that they've built several of these locations. These offerings that we're referencing now are some of the ones that developer built. So it crisscrosses the whole country from wherever Tesla deems there's a need. They basically say, jump, and the developer says how high.
Do you anticipate this continuing for the next 5 to 10 years?
I do. I very much do. I think that the collision sector, specifically collision and servicing of their vehicles, I think they could put their foot to the floor and need. I think presently Tesla only has 40 of their own collision centers across the country. They probably need at least 400 or 500 if they want to handle their rollout.
Okay.
Or more.
Will there be to move into the repair side as opposed to the collision side?
We have some of those under construction right now as a
Good to know.
developer, and those are ones that might very well find themselves in a future net lease offering.
Okay. We're pushing about a half an hour here. I just wanted to see if anybody else has questions. And I don't see any, but anybody have any questions before we end the call? Well, Matt, it looks like everything has been answered by you, so
There you
I
go.
appreciate it. Well, I appreciate everybody coming on, and if anybody has any questions, I'm going to leave my email here in the box so people can see it and they can respond to me if they want information. And we can go from there. I'm typing that as we speak, and then we will end the call. So, anybody wants to get a hold of me to discuss further, feel free to reach out and we will do what we can. Thanks a lot, everybody. Bye.